Hello, we're going to show how to provide the relevant currency exchange rates in the input file so that the B2T engine can automatically perform the currency translation during the tax consolidation for an entity group. We know that in an entity group, child companies may use different currencies for their accounting books. In order to perform tax consolidation, a child company's account balances need to be translated into the parent company's currency. This currency translation process follows the relevant accounting standards, such as ASC 830 for the US GAAP. The B2T engine will do that translation automatically during its tax consolidation process, as long as the user provides the relevant currency exchange rates for the accounting period. We will use a simple two-entity example to show how to provide the exchange rates in the input file and to show the currency translation results in the output file. So here is our example. We have two entities. The parent owns a subsidiary, sub 1. And we go to the corresponding input file that we had prepared for the engine. And we have used that in some other tutorials as well. So we describe the business facts to the engine. We tell the engine there are two entities, P and sub 1, and both were using US dollars as their book currencies. We tell the engine that there is an entity group named P group that's led by the entity P. And we further tell the engine that P owns sub in this group, owns the ownership percentage is 100%. And we further tell the engine that there is a tax obligation for the P group to do the consolidation based on the US GAAP. And there are some account mapping information. Now, for the recurring input for that specific period, we tell the engine that please do a tax provision for the group to satisfy that obligation. And trial balance will be in these two separate sheets, one for each company, which in our case is very simple. P has a revenue of $1,000 and sub 1 has a revenue of $1,000. It's dollars because in our setup, we had indicated both were using US dollars. So we describe the business to the entity and we're going to submit it to the B2T engine to calculate. The engine may start cold, so it may take a few seconds to warm up. So it's down. Let's go to the output file. And I open that output file, and we see the engine perform two calculations, one for P, one for sub 1. Those single calculations were performed in the currency of USD as we had specified, and the dollars was 210. Now, the engine also performed the tax consolidation as we had specified for the two entity group, and the final result is over there, and everything is in US dollar. So there's no currency translation to be concerned with. Now we ask ourselves, what if sub 1 was using some currency other than US dollar? Let's see what happens. So let's go back to the input file. We close this output file. And here's our input file. And we want to tell the engine that the sub 1 is actually using euro. Let's say EUR. That's the international currency code. So we're going to save it. So now engine knows that sub 1 is using everything in euro. So the trial balance 1,000 would mean 1,000 euro. We go to the easy button and submit it again. we got an error. It basically says something about cannot find uh, foreign currency exchange rate between euro and USD. Fair enough, because we really haven't supplied that information yet. So let's go back to the input file and actually supply those information. We close it and we close the output file. And here's our foreign exchange rate information. So to make things simple, we're going to enter just one single record. Here we simply tell the engine that for this accounting period, the foreign exchange rate between euro and US dollar is 2. That is, 1 euro is 2 US dollar. So once given that information, we can submit again. So we're going to save it and we're going to submit it. So it's down. So now let's open the output file. So we see the engine also performed the two calculation again, one for P, one for sub, and for sub 1 in this case it's calculated in euro. So the 210 result is actually in euro. Now, in the consolidation calculation, we see that for sub 1, it is in USD. Let's just highlight that one, okay? It is now in USD for sub 1, okay? So the engine automatically converted the euro amount into the dollar amount. And let's go further to the provision sheet for sub 1. So we go to the sheet by using the shortcut arrow over here. So here's a calculation for sub 1, and the currency is in euro. And here we have our book to tax adjustment section over here. We see that for every account, revenue, including all the related tax accounts, there is a FX foreign currency translation section that's being provided. So every account is being translated into US dollar. It was euro, it was translated into US dollar using the exchange rate 2 because we had said so in the input file. Here now, one may wonder, what about using different types of exchange rates for different types of accounts? For example, according to ASC 830, we generally would use the average rate for the income statement accounts and use the spot rates for the balance sheet accounts. How can we do that? It is difficult to see because we have only one account over here. So let's go back to the input file and add a few additional information. Here's our input file again. Now, we only supplied one record that says in the foreign exchange, euro to dollar is 2. We did not say anything about what type it is. We go up a little bit. We see it could be spot or average rate. If we say nothing, it'll be default as spot rate. So we're going to add a record that says the average exchange rate for the accounting period. Let's say it's 3. So here's one more record that says the average exchange rate for the accounting period is 3. Now, to make things a little bit more interesting and more obvious for our observation later on, is that for sub 1, trial balances, we're going to add a few more accounts that basically the representative one, like the income statement account and balance sheet accounts. So we have two more accounts for sub one. One is our meals and entertainment account, which is the income statement account, and we have an accrued rent account, which is an asset account. So these numbers are now in euro, and we also have to map those accounts into their appropriate types. So we go to the setup, and we need to add a few records over here to tell the engine what those accounts are. Okay, we add these two records to tell the engine that one account is meals and entertainment expense. The other one is accrued income, which is an asset account. So that's it. We're going to submit it again. We're going to save it. And we go to the easy button. We're going to submit it. So it's done. So we're going to the output file. And here we see the euro 210, it got translated into US dollar for sub one. Here to make things easier to read. US dollar now. And we go to the, so roughly say 210, and it's now so it's 3 times, which is the exchange rate 3 that we entered. So we go over there to see more details. We want to see what happens to each account. So we follow the shortcut arrow over here. Now, this is the calculation for sub 1. It was recorded in euro. And for each account, the revenue, meals and entertainment, and the accrued rent, we see it is translated using the rates of 2, which was a spot rate, and 3, which was the average rate. Look at the notes over here. Choose average rate for income statement account and choose spot rate for the balance sheet account. Further, we see that there is imbalances due to the differences in exchange rates used for different accounts. They contribute to the CTA account, that is the currency translation adjustment in the translated book of sub 1. Now the CTA would impact the parent's investment account, which may cause additional book to tax adjustments on that account, which in turn may cause additional tax items in the tax consolidation process. There are lots of details. The engine put all those details in a separate sheet. That's the multi-entity sheet. And for this tutorial, we're not going to get into that. So as you can see, all those complexities are all handled by the engine automatically. So to summarize, when a subsidiary's accounting book is in a different currency from that of a parent's currency, a user only needs to provide the relevant exchange rates for the accounting period in the input file, like we have been doing. So as long as those exchange rates are provided, the rest of the work, the engine will automatically perform the necessary currency translation during its tax consolidation for the group. That's it. Thanks for watching.